Hello and welcome to the chapter 2 class. Sorry about the change of the schedule due to some construction sound going on, and luckily it seems dimming, so let's start. So chapter 2 is about the asset classes and the financial instruments. So let me type our learning objectives on the whiteboard. In a second. So learning objectives. One, to distinguish among the major assets that trade in money market and in capital markets. So our goal number 1 is to distinguish among major assets that trade in money market and in capital market. And number 2 is to describe the constructions of stock market indexes, or we can call it index. Okay, and number 3, we're gonna have to calculate the profit or loss investment in options. So our goal on this chapter is to distinguish among major assets that trade in money markets and in capital markets. So what do we see here is we have to distinguish among major assets, right? So inside of the asset, we have different asset classes, right? And we have two markets. We have money markets and capital markets, right? So we have to distinguish these assets, which belongs to money market and which belongs to capital market, okay? And number 2, this to describe the construction of the stock market indexes, right? So we can have our similar, the familiar ETF as SPDR, right? As an SPDR that follows S&P 500, right? And we have what? Micro NASDAQ, right? I'll say E-mini NASDAQ, or we have QQQ that follows what? NASDAQ, right? And we have DIA, which follows the Dow Jones. Right, so we are seeing a lot of ETFs in the real life, and we're gonna describe the construction of those stock market indexes. Okay, and number 3, we're gonna calculate the profit or loss on investment in option and future contract. So what is the sequence? First, right, we have asset classes, right? We have 3 classes, and inside of it we have many different securities, right? So we're gonna distinguish which asset belongs to money market and which goes to inside of it we have something goes to capital market, right? We have something called money market and capital market. So what is the main difference between those two markets? One is for shorter term or short-term investment, whereas we have capital market that is a little longer, right? Comparably longer investment, right? So what should be the characteristic of the money market securities? Shorter term investments. So it is what? Highly liquid, right? So we can make the security into the dollars, right? So we have the security and we can make it into money in no time or very short time, right? So we can consider the security is having the similar value as money, right? That we call the money market securities. And capital market, we have it for a little less liquidity and a little bit of spread from the current value and the real value. So once we know that, right, we're gonna look at what makes the indexes, right? Inside of it, inside of the stock market, right? We make some ETFs, right? So what are these ETFs? It should go to a part of the derivatives, right? But actually it works as one security, right? One specific security. And number 3, to calculate the profit or loss of investment. So after we define and how it works, we invest, right? Then we want to look at our result by calculating the profit or loss on investment in later so we came in there, and now we want to look at the derivative market profit loss by looking at the option and contract profit loss, right? So we're gonna look all of these 3 classes in financial market, okay? So let's start our chapter 2. So as we know, we have 3 main asset classes in the asset, right? So we have first fixed income security, and second common stock, and third derivative securities, right? So we're gonna make derivative security only for right now is option and contracts. Okay, so we know that fixed income security is what? You lend your money, right, to company or government, right? So your money goes into these guys and they give you back a what? I owe you that much of money, so I'm gonna give you that principal plus some interest, right? That is the fixed income security concept. And for the common stock, this is not lending money, right? So you're purchasing a part of the company, right? So you become a partial owner of the company. So did you lend your money to someone or borrow some money from someone? No, you just purchased the value of the company. So if the company value goes up, your common stock price will go up, right? And if the value of the company, the future of the company drops, right, then the common stock price will drop also, right? So this one is just what? Money goes in and out. For this, you are partial owner, and your value increase and decrease according to the company's value. And also, if you become what? This is a partial owner, right? So you have the voting right, right? So that is the main difference between the common stock and what? Preferred stock, right? This is called the preferred stock, but it's in form of note, right? You lend money, they borrow the money from you, and they give you the paper with some interest written. And third, we have options and contract, which bet on the futures, right? So both have, like for common stocks and fixed income security, we purchase that today, and it's in effect today, right? From today. So if you purchase the common stock, your value goes up and down according to the stock price, right? And the fixed income security is now fixed, right? So once you made the deal, is done. Once you made the deal, you have to make another decision for the common stock, right? What about the derivatives? It has the date, right? We call that maturity, right? So options has the date to maturity, so we can change after we made some decision. And contract is a little bit more of betting on it's like a zero sum, right? The contract is like a zero sum, so you're kind of betting on like you're gonna win and the other side will lose, right? That is the simplest concept of the contract. So we're gonna talk about these in detail in the latter part, so let's keep it here and move on. Okay, so we have 3 asset classes and they're having different forms, right? Fixed income giving you interest, right? And it is fixed and the value doesn't change. The common stock, you purchase the right, and the value changes, right, with the company's value, right? And the derivative securities, we're gonna talk about it later, and it's about the future, right? Okay, so next slide. So in the money market, what do we have, right? So like I said before, the money market is what? Highly high. The T is the main characteristic of the money market, right? So it can be converted into cash right away or in no time. So let's see, we have treasury bills that we call T-bill, right? And we have certificate of deposit, we're gonna call it CD, and commercial paper, CP, bankers acceptance, and Eurodollars. For these, I'm not gonna make it short because we're not using these a lot, right? So we're gonna talk about these 3 mainly, and we have repo and reverse repos and brokers fund, federal funds, and LIBOR. So we're gonna talk one by one how they are constructed. So starting from the treasury bills, right? So what is T-bill? So let's look at the definition. Okay, so definition of the treasury bill is short-term government securities issued at a discounted from face value and returning the face amount at maturity. Okay. Can I make it larger? Hope so. No? Okay, so I might not able to largen it. So let's see. So definition of the T-bill is the short-term government security issued at discount from face value and returning the face amount at maturity. So what does it say is we are lending our money to where? Investor. Once again, I'm gonna just rewrite briefly, okay? So definition is short-term government securities issued at discount from face value, right? And returning the face value, right? So the definition is a short-term government security issued at the discount from the face value and returning the face value. So what does investor earn? So investor, and we have government, right? So money goes in, right? And T-bill comes out, right? So how much money is going in and how much money value of the T-bill is coming out? So it say what right now. So they issue at discount from the face value. What is the face value? If you look at the dollar, right? a dollar have a sign of $1, right? That we call face value, right? If it has 10, we say, that is $10, right? So the T-bill has a face value of $10, right? But investor only issued at discount, so pay a little less, right? So let's say 10%. If it's 10% discount, he only pays for $9, right? So the sequence is investor invests less money, right? Discount value, and then the government pays you back the whole value of the base, right? So in return, you are gaining 10 negative 9 a dollar from this transaction, right? This is the concept of T-bill. So let's look into that. So the issuer is the federal government, right? And the denomination, or we call it the face value, right? Commonly from 1,000 to 10,000. And maturity is how long you're gonna lend my $9 for, right? So it starts from 4 weeks and in the maximum 52 weeks. So what does it say is that at most 1 fiscal year, right? So the maturity itself is really short, right? So if you invest, you can tell, this money will come out at the end of this year, or should be, in 4 weeks you can get it back from the government. So I'm gonna pay you with T-bill right now. Wouldn't make a difference from the dollar, right? We call that liquidity, right? T-bill is very liquid because they have short maturities, okay? So the deferred risk is none. Why do we call it no risk? Because treasury bill is from federal government, and if we don't think the federal government will fail, so there is almost none of the default risk. And we have an interest type, right? So how you get your dollar from is the difference, right? The money you paid is less than the money you will get. So we call that discounted, right? And if you earn some yield from this treasury bill transaction, you have to pay tax to federal government, but it is exempt for the state or local government. So why do they make a little exemption? Because they want to have it very liquid, having what? Low risk, low cost, and low return. Okay. All right. So next, move on, and we have the certificate of deposit. Okay. So what is the certificate of deposit? This is a certificate, right? Certificate of deposit money, right? So certificate is a paper, right, of your deposited money, right? So it says, let's say $10,000 is deposited to your account or to this non-anonymous CD, right? So this paper guarantees this has a $10,000 value, that is CD. So where does it issued from? It's issued from depository institution, or we have it as commercial banks, right? Banks. Right. So we can have these CDs with the commercial banks, and without the financial crisis, we're okay with the commercial banks, right? So we call this is very safe, and this has a high liquidity. So let's look at it. The denomination is from any 100,000 or more, right? So what? If you want to have a CD, you have to have at least $100,000, right? So if you put $100,000 or more in the bank, right, that will give you interest, right? So if you put investor and we have bank, right? So if you put more than 100K into the bank, that will give you, oh, there is your CD, right? So your deposit is cleared, and we can we can issue a CD for you. Oh, there is 100K deposit at the account, right? And the bank is using this deposited money to invest or borrow money to the different commercial companies, right? So the interest type is, if you put 100K, it will be added, right? Some percentage of your deposit will be rewarded with interest, right? So we have it add on. So in return, you'll get 100K plus, okay? And if you make money from this bank certificate, you owe to all of the governments, right? So this is from bank, and the other, right? So T-bill was from government, so you don't owe tax for the state and local government, but CD is from commercial banks, so you have to pay all the taxes. And the maturity is even shorter than the T-bill, because anyway, government is having lower default risk than the bank, right? So if you look at the default risk, there is something interesting, right? So before, right, we had no risk, but now we have some risk. So what happens is, if you lose, right, if you lose all of your money, right, first 250K can be paid from the insurance of FDIC, right? So if you put let's say 500K, right, to the bank, you'll get a first 25K back in the event of bank failure, right? And if you put 100K, right, the first 250K, so all of your 100K can be paid back when the bank failure, right? So there is a little bit of the insurance compared to no default risk treasury bill. Okay, so let's look at the spread on the CD and treasury bill. So what is CD? CD is a bank interest, but high, right? And treasury bill is government or Federal Reserve interest rate, like similar to those values, right? So we can think of it as what the government is thinking the interest rate should be at the moment is the treasury bill, and according to the financial conditions, what is the bank is giving you as the interest, right? So what we want to know is, when the spread, right? Spread is the difference, right? So difference from CD negative T-bill rate, right? So we can assume that CD will give you higher rate than the treasury bill, because this is from the bank and this is for government, right? So the spread can be defined like CD rate negative T-bill rate, right? So when do we have a large spread between two? When CD is high and T-bill is low, right? So let's see, we are having, let's see, 1, 2, 3, 4, 5, 6 named written big spreads on CDs and treasury bill throughout years. So what happened? This is OPEC is oil shock, right? So there was another oil shock, Penn Square, okay, another bank failure, the market crashes, blah blah blah. So what we see here is all of these are financial crises, right? So we know that these are all financial crises. So what happened during the financial crisis to make the spread bigger, right? So to recall, right? Recall the 2008 financial crisis, which has almost like second to the largest spread, right? So recall 2008, what happened, right? And what was the solution from the government? They lowered interest rate, right? So we saw what? The spread between LIBOR and T-bill was widened for a while, right? And then they coming back to consolidate. But we saw that spread in the previous chapter, and we're seeing the same concept again. So what happens when we lower the why we lower the interest rate? Because we want to eliminate the market volatility, right? So government did for the T-bill part, right? T-bill part, government want to lower the T-bill rate. So we can think of it as lowering the interest rate to calm down the market, right? And in the financial crisis, right, the CD part, what does bank do? So what happened in the 2008 was what? Everybody want to withdraw, right? Draw their money out from the bank, right? Because they didn't believe the bank, and the market was highly weakened, right? So it is hard for the bank to what? Lend money to individual business owners, and they fail to have a mass unemployment rate, right? That's the story goes, right? So what happened is, in the case of financial crisis, CD or bank has to pay you higher interest to borrow, right? And then they have to lend it later, right? To lend the money, which is the major job of the commercial bank, right? They have to raise the funding. And to raise the funding in the financial crisis, you have to give higher yield than the normal era, right? So what happens when CD rate goes up and T-bill rate goes down? So once again, the spread, right, was CD rate negative, T-bill rate, right? So what happened to CD rate? So change of the S is CD went up, right? And T-bill went down. So we're seeing bigger spread than the normal years, right? So that's how we understand the CD and Treasury bill spread and the relationship. Okay, so next we have CP, right? There is a typo right here, the certificate of deposit now, commercial paper, and we call it CP. So what is the difference from CD and CP? They look very similar, right? We have the certificate of deposit and we have a commercial paper. So the denomination is same, 100K, right? And maturity, we have a little longer, 270 days, and usually 1 to 2 months. So we are looking same values as CD, a little longer maturity than CD, and liquidity is okay, it's okay, right? It's okay, and the default risk is unsecured, right? Rated mostly high quality, so higher risk. And interest type is discount, so that there is another different, and taxation is same. So why does same money goes in and different results coming in? Because of the issuer, right? Here the commercial paper is issued from the corporations and any financial institutions, but the CD can be only issued from a depository institutions, right? So these are different. So for CD, right, this is from banks, the big banks, and they have lower default risk than corporation, any companies, right? It says it's a large credit-worthy corporation, but like we have so many large credit-worthy companies in the U.S. market, right? So say it's like many companies can issue the commercial paper, right? So which if you invest in the bank, right, it will consider comparably safer than to invest in the company, right? Because banks are having a very conservative moves, whereas the companies has to grow their future, right? So they have to move aggressively, right? So what happens is the interest type is discounted, but it is normally higher than CD rates, right? So they're giving more in return, but the credibility or default risk, right? Credibility a little lower than bank, and the default risk is a little higher than bank. So CD, CP, same concept. Who's the issuer, right? CD from bank, right? CP from company. And after we got the new innovation as a asset-backed commercial paper, right? Before we only had, oh, if you put money, I'm gonna give you the CP, right? But after we got the asset-backed commercial paper, like what? Mortgage-backed securities, right? That made our financial market crush it. Okay, and let's move on. So continuing the money market, we have the banker's acceptance. So let's read first. Purchaser authorizes a bank to pay a seller for goods at the later date. And when purchaser's bank accepts the trap, it becomes a contingent liability of the bank. Okay, so what is this, right? Purchases. So this is when you have money, right? When you are transacting in foreign countries. Let's say we have a country A and country B, right? Country A has a well-known bank, let's say JP Morgan, right? And country B, which is a third world country, has a bank name ABC. Let's assume that, right? So for JP Morgan, right? So for the JP Morgan, we think, this bank is one of the best bank in the world, right? So if you have some money in the JP Morgan, I believe you, right? So if JP Morgan issue a banker's acceptance, right, that you have money inside your inside your account in ABC, right? Then the transaction is made a deal. Right? From the A cannot believe the purchaser at B, right? So B says, oh, ABC Bank, let me show that purchaser A that I have the qualified money to purchase that product, right? So how can we do it is, send some paper to the JP Morgan to make the proof, right? So there was a little transaction sequence, and after all, there is some kind of paper going, and we made that valuable. That is bank's acceptance, right? So this is tradable after the banks accept, right? Because they once they accept, right, it becomes the liability of the bank because they said that is there, right? It is traded. So if someone claims, I want that value out, right, then bank has to back up in the event of failure of customer B's money in the ABC, right? So JP Morgan's banker's acceptance is very valuable in the market and highly liquid, right? So this is in the money market. And we also have the dollars denominated time deposit held outside of US, and we can think of it as deposit held in outside of the US, right? So we deposit outside of the US because they pay higher interest and less regulations or taxes, right? So some people want to have it outside of the US than inside of the US. Next, we have the federal funds and the LIBOR. So federal funds are the funds trading in the reserve held at the Federal Reserve. So all of the banks are required to have some kind of reserve, some portion of the reserve in their bank in the Federal Reserve, right? So, the commercial bank, right? Commercial bank borrows money from investors, right? Borrows money from investors, and they lend it to corporations or companies, right? So they money in, money out. So how much money is left in the bank? We don't have so much left in, right? So whenever the investor calls their claim, oh, I want my money out, they should be able to pay them back, right? That's why we want to have the Federal Reserve at similar to 10% at all time, and this 10% should be put inside of the Federal Reserve, right? So when you have less than 10%, right? So let's say you have 8% of your total borrow in your reserve, then you have to increase 2% immediately to meet the 10%. Then what happens is, since you don't have any the money to put money to cover that 2%, you have to borrow from another bank, right? Another bank who has, let's say, 13% of the reserve can borrow there and lend their leftover to some bank in deficit, right? So in this transaction, interest rate is calculated, and that is all that becomes the key interest rate for economy, right? So it's interbank interest rate to keep reserves at certain level. So for example, 10%, right? To keep that 10%, you have to borrow, and sometimes you have leftover, you can lend it, right? And in the interbank transaction, the short-term interest rate is calculated, and that interest rate becomes our base interest rate for the economy. And we also have international interbank offer rate, right? So the same concept, but it's interbank not only in the US but in London and everywhere, right? And it becomes a worse base rate for many loans and derivatives, right? So inside of the US, we use that as a fundamental, right? And for the world, we use the LIBOR as the fundamental key interest rate. And we also have the repurchase agreement. So this is repurchase agreement, and this is the opposite side, okay? So let's look at it. So short-term sales of security with the promise to repurchase a higher price. So now we have a little different concept. Before we have investor, we have the company, and you invest money and they issue some paper, right? That was the transaction. But now we have different, right? We have we're not like investor, but let's say investor and company. So what do we do is we don't invest, right? We are borrowing money, right? Money is coming out and you sell your security. So this is the opposite, right? So you sell your security to some company, or here we sell it to broker, right? And broker pays you the money, has an equal value of that security. In return, you have to pay back, right? Money, right? Plus some interest to get back the paper, right? So this is what you want to the person, right? You want to borrow money for short term, right? So the basic concept is you want to borrow money for the short term, and you have some collateral, right? So collateral of I found this security and I can use this as collateral. So you found a security that can be collateralized, right? So you give this collateral to the broker and get the money you need right now, and you pay back with interest rate. So that we promise to repurchase at higher price. You have to get back your collateral once the deal is done. So RP is a collateralized loan, and many RPs are just overnight, and RPs may have a 1 month maturity, right? So let's look at the opposite side, right? So reverse RPs is about the lending money, right? Obtaining security title as collateral, and haircuts may be required depending on the collateral. So what happened here in the repurchase agreement itself was what? You investor, right, a broker or a company, right? You want to borrow money and pay back, right, the principal and interest, right? Why he pays you is because there is a collateral I'm gonna give you for a while, that is security, right? And of course, if I pay back the principal and interest, you're gonna give me back that security, right? That was a repurchase agreement. So let's look at the reverse RPs. So it's like the broker side, right? So I and B. Let's have it the same, but like to lending, right? So if you want, if the broker borrows money, right? If you lend your money, B of dollar goes to broker, and they can pay us back at dollar plus interest, right? But how this is calculated? Same sequence. Collateral goes in, right? And collateral goes out when they pay back, right? So what we have to notice here is what? The borrowing value and the payback value is different, right? You pay back, right, more than what you borrowed. That's why I have $2 signs and $1 sign, right? So what happened here is you get the base value and you pay face value plus alpha, right? Here, do you pay the broker base value? No, they say, haircuts may be required depending on the collateral. So if the collateral is not great, right, what we're gonna do is, okay, the collateral's face value is, let's say, $10,000, right? And the broker wants to borrow $10,000 from me, but this collateral is not like T-bills, right? So I want to make sure, okay, I'm gonna take the in advance interest from this face value, right? So I'm just gonna give you the 90% of it, right? So you'll only get $9,000 as a collateral of the $10,000 value of security, and and you have to pay back the base value, right? So 10,000, all of the 10,000 should go in, right? You get less, you pay more. This one, you get the what? Same value of the security, but pay back more, right? So there's a little difference, which someone is the interest type of add in, and different one is the discount. The other one is discount, right? The same sequence, one thing used add in, the other used discount. That is called a haircut. Let's talk about the broker's call. I don't know if you are familiar with the maintenance call, right? Maintenance call from the broker, right? If you're actively investing your money in the stock market at this timing, you might heard maybe once or twice about it if you didn't really actually face it, right? So let me talk. What is this about, right? So this is about everything is about lending money, right? So here we have broker, right? And we have investor. So what we do is, I have initial funding of 10,000, right? So I want to invest in the stock market. And then they open a brokerage account, right? And opening the account will let the investor know, oh, you are eligible to use our money with some interest rate, right? So I can borrow you some money with little interest rate, right? Then you can purchase more of the stock with only $10,000, right? So if the broker borrows 100% of the investor's initial funding, that he will get $10,000 more to use to be purchased at the stock market, right? So that's how the broker's money going to investor to be redirected to the stock market. So what happens next is this, right? So when we have asset, right? Asset equals to liability and equity. So we can think of the liability of what? Bank loan, right? In this case, this is brokerage loan, right? And for the equity part, we can think of it as my initial funding, right? So what happens if my equity decreases? Liability keeps the same value and asset decreases, right? So that's when the stock price goes down. If you invest liability, right, the margin plus your funding to purchase some stock, and if the price goes down, you'll get a margin call, right? So why does it happen? So once again, right, so let's assume you have $10,000 in hand, right? And the brokerage firm decided to give you, okay, 100% of your funding could be borrowed from the brokerage, right? So if we look at the balance sheet, right, we have asset of cash, 10,000, and we have the all of the financial assets, and another cash of $10,000, right? But in the liability and equity, we have the liability of $10,000 to brokerage, and we have to pay not only the principal but 1 plus some interest rate, right? And we have the equity, which is the part of the A negative L, right? So when does the margin call happen? The call is to what? I want my money back, right? So as a banker, right, as a borrower, the brokerage may call you to, I want your loan to be repaid immediately. That is called the broker's call, right? So when does it happen is if the asset value decreases, right? So when does the asset value decreases? If you invest all of these to $20,000 in the stock market and assume the price of the stock goes down, right? Then the value of your asset, which is converted to now what? stock, right, 20,000, right, can go to, oh, now the balance sheet is different, right? Asset, liability, and equity, right? So stock, 20,000, let's assume it became 15,000, right? What happens to the liability? It remains the same, right? 10,000 times 1 plus the interest rate, and equity is what? Stock asset minus liability. So if we look at the equity, right, over asset, we can know how much of the total asset belongs to us and the rest belongs to the bank or the brokerage firm, right? So okay, so once again, stock, liability, equity, right? So if we look at the total asset, equity over total asset, what does it show is my money over total investment. So it shows how much percent is from my own money, right? From me. The other side says what? L over TA is the other side, right? So percentage of not from me. Okay? So when does what happen is if the not from me is increasing or from me is decreasing. Because of what? Because E plus L equals to TA, and thus if we have E over TA plus L over TA, we'll have what? TA over TA, that equals to 1, right? So this plus that should equal to 100%. So one thing, measuring one thing can capture the other one too, right? So normally we capture this part, right? So your equity over total asset has decreased, right? Let's say it's more than 40%, right? That means your liability is over 60%. And that is not the broker wants, right? So they said some percentage value, they feel it's risky, right? And if it decreases below this point, then the broker calls you to have, okay, I cannot send anymore. Either you put more money in your equity part to decrease the equity over total asset, or we want our liability out, right? Our money out from your brokerage account, right? So you have to be mindful in using the margin, right? It may give you a better profit, but it may cost you a lot of money. Okay, so we're gonna stop here and continue the next part on next week. Thank you and have a good night.